A couple weeks ago, I was at an MBA alumni event at my school and got to catch up with a former classmate of mine. Let's call her Erin. She asked me if she should sell her investments because she kept hearing about Trump's tariffs and Trump's recession and wondered how close we actually are to a recession. Erin studied human resources while I focused on financial management. But back in 2016, I remember watching Trump's election unfold with her in the courtyard of our campus, and we spent a lot of time talking about the impact that his presidency had on the economy and how his tariffs affected the stock market. By the way, if you're new here, welcome. I'm Anastasia. Having grown up without much, I made it a personal goal of mine to learn everything I can about money and wealth building. My full-time job revolves around managing multi-million-dollar budgets and cash flows and making sure that the money is spent efficiently. And my friends and colleagues often chat with me about how to be smart with money, how to make money, how to build a business, how to save, invest, and ultimately how to become financially free. So in this video, I'm going to tell you how that conversation with Erin went and how Trump's policies are affecting the economy today and what they might mean for the future, both the stock market and the economy. And if you're watching this and if you're wondering if we are headed into a recession or if now is the best time to buy or sell stock, I hope you'll find something in this video that will help you get a sense of where the US economy is today, where we're headed, and what you can do to prepare if there is a recession in our future. What causes a recession? Erin and I started with the basics. A recession happens when the economy slows down significantly for a period of time. It's like a car running low on gas. The economy starts to sputter as it runs out of fuel, but with the right refueling, it can get back on track. So I told Erin that these are the things to watch for that may indicate that a recession is coming. GDP shrinking. That's just the total value of all goods and services we produce. And when it goes down, it's a big red flag. Rising unemployment. When companies start cutting back and laying off employees, that's another sign that things are not looking great. Less consumer spending. People stop buying as much, which slows down the economy even more. Stock market drops. Investors start getting nervous and pull back, which can cause the stock market to dip. So she said, it kind of sounds like what's currently happening. Are we actually headed for a recession? And honestly, it's kind of a mixed bag, so we decided to break it down. The economy right now. Are we in a recession? Not officially, but the economy isn't exactly thriving either. To get a clearer picture, we turn to the Conference Board. It's an organization that tracks key economic trends like consumer confidence and recession risks, helping businesses and investors stay ahead. Here's what their latest data show. The economy is losing steam a little bit. The Conference Board's latest report shows that the GDP growth has slowed down since the last quarter and is projected to continue slowing down for the rest of the year. And one big reason is tariffs. Trump's latest round of tariffs is making it more expensive for businesses to get materials. That means higher costs, slower expansion, and potentially fewer jobs down the road. Jobs are still out there, but layoffs are creeping up, especially in tech and finance. And the big reason for that is labor shortages. Back when I was in grad school in 2016, immigration was one of the biggest debates. Fast forward to today, stricter immigration policies are leaving gaps in industries like construction and agriculture. That's driving up wages, which is good for the workers, but is making it more expensive for businesses to operate. And when companies need to cut costs, they start trimming jobs in other areas. The stock market has been a roller coaster. Some days it's up, some days it's down, but overall it's kind of just uncertain. The S&P 500, the Dow, and the Nasdaq are all slowly crawling up, but investors hate uncertainty, and right now there is a lot of it. Tariffs, new corporate regulations, potential trade wars, it's all making the market uneasy. Consumer spending is where things start to get shaky. Consumer confidence has been dropping for 4 months straight. People are spending less, not because they want to, but because prices keep going up. Inflation is still a problem, and tariffs are only adding to it. When businesses pay more for imported goods, they pass those costs down to consumers. And when everyday items get more expensive, people start cutting back. The Federal Reserve is trying to walk a very fine line. They're keeping high interest rates steady for now, but they just raised their inflation projections from 2.5 to 2.8%, which means that they're worried. Because high interest rates make borrowing more expensive for both consumers and businesses, they can slow down already slow spending, investment, and economic growth, which is not ideal when you're trying to maintain a healthy economy. Now, the Fed faces a tricky situation. If they lower interest rates, it would likely fuel even more inflation. Low rates make borrowing cheaper, which can encourage spending and investment, driving the prices up. So they're trying to cool things down without triggering a full-blown recession. Inflation is hard to control, and if the cycle keeps going, this could make the recovery much slower than expected. And then there's housing market. It's cooling off, prices aren't rising as fast, and fewer people are buying. And one big reason is, again, tariffs. Tariffs on building materials have pushed up construction costs, making new homes more expensive. And first-time home buyers are feeling it the most. Higher home prices plus high mortgage rates, that's a really tough market. Where are we headed? So Erin said, where are we headed? Is this just short-term pain for a long-term benefit, or is it just pain with no benefit? And honestly, that's the million-dollar question. Trump's policies have always been about shaking things up, and that can create a lot of uncertainty, especially when you're talking about the economy. Let's take a look at what's going on right now and how his past actions could shape the future. Under Trump, we saw aggressive tariffs on foreign goods, especially from China. The idea behind this was to reduce U.S. dependence on foreign manufacturing and encourage domestic production. In the short term, though, tariffs made things more expensive for consumers. It all comes down to whether the shift to domestic manufacturing sticks and how quickly businesses adjust to the new costs. This could either lead to more jobs in the U.S. factories or put a financial strain on companies, potentially leading to job cuts or lower profits if they can't raise prices or move production to the US. Trump's corporate tax cuts were another huge part of his economic plan. The idea was that cutting taxes would give businesses more capital to grow, create jobs, and boost the economy. However, many businesses used the tax savings for stock buybacks rather than investing in long-term growth or creating new jobs. The question here is whether these cuts are creating real value for the economy or if they're just propping up the stock market. Throughout Trump's first term, we saw strong economic growth, but also considerable uncertainty due to trade wars, government shutdowns, and, of course, the pandemic. The response to the crisis included massive stimulus packages and a dramatic drop in interest rates, which helped the stock market rebound but left unemployment and business closures still lingering as major concerns. So where are we headed? It's hard to say, but looking at the patterns we've seen so far, the most realistic scenario is a period of tough adjustments. While there is a potential for long-term gains if the US can shift manufacturing back home and if the inflation stabilizes, but that's still very uncertain. The reality is inflation has proven hard to control, and with rising costs, we've already seen consumer spending dip. If this continues, we could face more pain before we see any meaningful recovery. In short, there are a lot of what-ifs in Trump's plans. The actual progress has been slow and the risks are very real. So what do we do to prepare for this tough time? Erin asked me if we should sell our investments, and I know that it's what on a lot of people's minds, so I wanted to show Erin what happens if you sell investments using the last two recessions as an example. Let's look at how painful both the 2008 Great Recession and the 2020 COVID recession were and what recovery looked like. The 2008 housing market crash was a slow-moving disaster that built up over time. People were taking out huge loans that they couldn't afford, and banks were approving risky mortgages, kind of thinking that the housing prices would keep rising forever. The economy shrank by about 4.3%, and it took years for things to recover. As companies started cutting back, they began laying off employees. At its worst, 10% of Americans were unemployed. The job market took a big hit and recovery was slow. With so many people losing their jobs, consumer spending took a dive, and when people stopped buying, businesses struggle, and that makes the economic downturn even worse. The stock market crashed with S&P 500 losing over half of its value. Investors got nervous, pulled back, and the market didn't start bouncing back until much later. The 2008 recession was tough because it wasn't just a temporary dip, it was a major breakdown that affected the core of our financial system. But despite that, it only took 4 years for the market to reach pre-recession high. 2020 recession, on the other hand, was completely different. COVID-19 forced the economy to hit a giant pause button. In just one quarter, the economy dropped by 19.2%. That's a huge decrease. And it was a huge red flag, but the economy bounced back quickly after that initial drop. Unemployment skyrocketed to 14.7% overnight, but recovery was fast. Jobs started coming back as businesses reopened and stimulus checks started circulating. Initially, consumer spending slowed way down because everything was shut, but when stimulus checks came in, consumer spending surged, helping to stabilize the economy. Despite the early crash, consumer spending ended the year down about 3.9% compared to 2019. The stock market fell by 34%, but it recovered faster than anyone expected. This recession was short and dramatic, but because of the aggressive government response, things bounced back much quicker in a matter of 5 months compared to the 2008 financial crisis. In both recessions, panic selling meant locking in losses, while those who held on reaped the rewards. If you sold in 2008, you missed out on one of the longest bull markets in history. If you sold in 2020, you likely missed on the fastest recovery ever. History shows that recessions are painful, but they are also temporary. Selling investments out of fear turns short-term losses into permanent ones. So how do we prepare for a potential recession? So Erin asked me if maybe the best thing is to do nothing and not even pay attention to what is going on. Well, not exactly. So here's what you can do now to protect yourself. Number one is stay informed. The economy moves fast, and staying ahead of changes can make all the difference. Keep an eye on key indicators, GDP growth, unemployment, and interest rate. I'll post a link to the conference board site in the description of this video so you can access it anytime. The more you know, the better you can plan. Maintain a long-term viewpoint and know your plan. If retirement is just a few years away, whether or not we may be entering recession, it's a good idea to reassess your portfolio and shift towards more conservative investments like bonds. This helps protect your savings from big market swings as you near retirement. And if retirement is still far away, focus on keeping a diversified portfolio, mixing stocks, bonds, and other assets. Diversification helps reduce risk and smooth out returns over time. Build an emergency fund. If things take a turn for the worse, having cash on hand is important. Aim for 3 to 6 months worth of expenses saved up. Think of it like an airbag. You hope you never need it, but if you do, you'll be glad that it's there. Diversify your investments. This isn't the time to gamble everything on one stock or one industry. Spread out your investments, stocks, bonds, maybe even some cash reserves. The goal is to reduce risks and make sure a downturn in one area doesn't wipe you out. Consider sectors like healthcare, consumer staples, and utilities. Those tend to hold on during recessions as they provide essential goods and services that people will still need no matter the economy. Cut back on unnecessary spending. If the economy slows down, your budget should be ready to adjust. Take a hard look at your spending. Focus on what you actually need so you have more flexibility if things get bumpy. Try to pay down your debt. Debt is risky when times are uncertain, especially high interest debt like credit cards. The less you owe, the less stress you'll have if the economy takes a hit, if something happens to your job, or if you keep your job but you get a pay cut. If possible, start knocking out those balances now so you have more breathing room later. And always remember that market dips are an opportunity, or can be an opportunity. When the market dips, it can feel scary, but if you're in a strong position financially, downturns can actually present buying opportunities. Lower prices mean you can invest more for less. If you have a long-term strategy, market drops might just be the chance to pick up assets at a discount. As Erin and I wrapped up our conversation, we both agreed on one thing: being in a strong financial position is the best way to prepare. The future might be uncertain, but if we're ready, we can turn any challenge into an opportunity. So if you've been wondering what's really happening with the economy and what it means for your money, I hope that this conversation gave you some clarity. No one can predict the future, but we can be aware and we can prepare for it. And the more we understand about what's happening today, the better positioned we are to make smart financial decisions and in the future cast a well-informed vote. Thank you so much for watching. I'll see you next week.